Hello guys, so are you excited already? So today we will be doing our tutorial. Like I said, I'm going to be taking us on how to trade forex from beginner to the expert level. So yeah, so I'm already ready. You can see my setup here. I'm ready. I'm ready for you. Are you ready for me? I'm ready. Okay, yes, we are good. So I'm going to be sharing my screen right now. Okay. So I believe we can pause screen. Yeah. All right. So once again, greetings everyone. So this is a forex tutorial. I'm going to be teaching you on how the forex markets work, which is the financial market. How everyone also can also go into this market and print out their own money, because this is like a financial market that we are printing out our money. That is basically how it works. So many of us might have been involved in so many mentor classes and so on like that, but believe me, I am going to make it very simple for everyone so that you can understand it. We will use less of those technical terms because those are also part of the things that affect a lot of traders. You will see other mentors focusing on telling you all these technical terms, but believe me, there are some you need, there are some you don't need. All you need to know is how it works. So, starting with forex trading, we are going to start by knowing what forex trading means. What is forex trading? Um, Many people might feel like, okay, why don't we start by opening, taking us on how to open Exness, do MT5, but believe me, no. What is the use of opening Exness when you don't even know the meaning of forex trading? So you have to understand what forex trading is. You have to understand how it works. Then you can know perfectly how to take advantage or how to be part of it. So forex trading, which is also known as the foreign exchange trading, it is a global exchange of it's a global exchange of currencies to make a profit from change in their relative values. So every one of us, one way or the other, we've involved in forex trading. Yes, you might not be trading it on the chart on your MT5, but so long you've changed one currency to another currency, what you've done out that at that particular time is called forex. So let's say you've one point at a time in your life change naira to dollar from all those aboki the change. You've done forex. If you've like at one point in your life maybe change to Ghana cedis or any other currency, you've done forex. So it is very simple. It is just like you changing different currency. We have Nigeria here now. We have US. We Nigeria, we are using naira. The US, they are using dollar. So if I'm going to change my naira to my dollar, what I've done there is forex. I have exchanged currency. So I've done forex, which is trading. I've traded my naira in order for me to receive a dollar. If you have dollars with you and you move to those aboki and say you want to change this dollar to naira, or you approach any of the banks and say you want to change this to naira, what you've done in that regards is forex trading. But now let's look at how you can make profit of it. How does this work? Now you can see traders buy one currency while selling another. You see, this forex trading that you see everyone doing, it is very simple. It is very simple, and it is until you understand the simplicity of it, the simplest form of it, that is when you will know how this really works. That is when you know how this really works. So this is like just exchanging a currency. Is like exchanging a currency. Why? the currency while making profit out of it. So please, sorry for those of us that are joining, please you have to um mute yourself. You have to mute yourself. If you are just joining, just mute yourself, please. Mute yourself. Thank you. Okay, so sorry, this is the reason why I want everyone to join because I'm recording this and I'm sharing my screen, going back and be admitting users. Yeah, but we just have to bear with that while we proceed. So this forex of a thing, do not be scared with the big name forex. Don't be scared because the banks are trading it or any other what is it called? People are trading it or so on like that. It's very simple. So whenever you exchange any currency to for another currency, what you've done in that regard is forex. Now, how does this work? Traders buy one currency while selling another. It is very simple. With the goal of profiting from the difference in in their value. See, this is the main key here. If you have US dollar, you have US dollar, and you want to get pounds. If you have US dollar and you want to receive pounds, now you changing your US dollar to pounds and with the aim of making profit from that exchange, it is called forex trading. So what we are doing right now is we are exchanging currencies. We are exchanging currency, but we have this aim of making profit from the currencies we are exchanging. Now, if a trader thinks the euro will strengthen against the dollar, they might buy euro and sell dollars. Why? With the intention of selling the euros later at the higher price. So it is really simple. Now let's say you are someone with the commodities. You are selling like sneakers, for example. If you are buying sneakers anywhere, you will be buying those sneakers with the aim of, okay, you want to buy these sneakers right now, but you want to resell it at a higher value than the value you purchase it because that is where you make your profits. Now, where do we make our profit as a forex trader? If I have USD with me, I have the dollar with me, and looking at the economy, looking at the euro currency, I can see that okay, euro might go up because euro is having more strength than the dollar. Then I'm going to sell my dollar to buy the euro. Now the euro I am buying, I am not buying the euro because I love euro. No, I'm not buying euro because I just want to keep euro in my bank or in my wallet. No, I am buying euro because I have intention of selling the euro once the price of that euro is higher than the price I purchase it. So this is very simple. So if you've done any trade with this intention of you want to make profit from that trade, what you've done is forex trading. Now, let's move to the next, which we have the base currency. We have the base currency and the quote currency. You might have seen something like this, which is you will see something like this, like we have what is it called? In your chart, you will see something like maybe GBP/USD. You might have seen something like this on your chart. So for those of us that have our MT5 on already, we would have seen something like this. So what we've seen here is what we call the base and the quote currency. The base and the quote currency. So this is called the base and the quote currency. All these things are called the base and the quote currency. So that is it. So these base and the quote currencies, they are let me exit this drawing. So these base and the quote currency, they are currencies that every one of us would have witnessed in once we open our chart, our MT5, we would have seen something like Euro USD, something like GBP USD, and so on like that. The first currency in a currency pair is what we call the base currency, because it is called, usually considered as the domestic currency. Why the second one? If we have Euro USD, Euro is the base, while the USD is the quote. If you have GBP USD, GBP is the base, while USD is the quote. So we should please pay attention to this, because if you are trading, you should know what you are trading, the why you are trading it. So base and the quote currency is also very important for every traders to know. You know that whatever currency you see at the first is your base currency, and whatever currency you see later is your quote currency. Now, if you should see a pair like this saying Euro slash USD equals 1.05, what this is telling you is 1 euro is worth $1.05. Please note, why is it 1 euro? It is because in this we have euro written at first. Euro is the first thing we have, which is the base currency. Now, the quote currency is giving you the value of the base currency. I want us to pay attention to this. The price of the currency pairs show how much the quote currency is needed to buy 1 unit of the base currency. That means how much the quote currency is needed to buy 1 unit of the base currency, meaning how much USDT is needed before you can buy 1 euro. So if you are just trading, some traders, we have many traders out there, they are currently trading, but they don't even know what they are trading. They just feel like, okay, this is our USD, this is Euro USD, I want to buy, I want to sell. What are you buying? What are you selling? Remember I said something. Forex trading is buying a currency at a lower price and selling at an higher price. So you are exchanging currency. So if you have Euro USD, what are you buying? So now you should take note that if you ever come across any trade saying Euro USD, and you click on buy, what you are saying is you are saying the euro is going to be stronger than the USD, and you are currently buying euro. If you click on sell, you are saying euro will be weaker than USD. You are saying USD will be stronger, and you are currently selling euro. This is very simple. Now look at this example. In a currency pair of Euro USD, Euro is the base currency and USD is the quote currency. This means that the pair Euro USD show how many US dollar are needed before you can get 1 euro. If this pair is GBP USD, it means that if it is GBP USD equals 1.05, it means that 1 GBP is worth $1.05. It is very simple, no matter the currency pair you are getting. So this forex of a thing is very simple, very, very simple. Just understand that this is what we are doing, this is what we are buying. Now, look at, we have major currency pair and we have cross currency pairs. What are the major currency pairs? When you see a currency pairs that is being paired with USD, they are major. But when you see a currency pairs that are pairs with GBP, JPY, Euro GBP, Euro CHF, CHF JPY, and so on like that, all these are just like a pair cross. They are cross currency pair. But these are the major currencies that you will see many people trading. Euro, what is euro? Euro dollar. USD JPY, what is JPY? Japanese yen. GBP, which is pounds. CHF, Switzerland. CAD, Canadian dollar, Australian dollar, and so on like that. So that is it on this. So the base and the pair currency. Now, before we move to the whole market section, I want us to pay closely attention to all this. Remember, let me recap. Forex trading is exchanging of one currency for another currency with the mindset of making profits. And when you see a pair like Euro USD, you are clicking on buy. You are saying that Euro will be stronger than USD, and you want to buy Euro. It is very simple like that. Just simple. All right, so now we are going to talk about the market. Remember I said our next topic is the technical part of this trading. We've discussed about the introductory to Forex, which is what we just finished right now. And now we are moving to the technical part of Forex. So before we go on our charts, because I'm going to be sharing you the charts, but before we go on chart, there are some technical things you need to pay attention to, which is the market itself. The foreign exchange market is a decentralized over-the-counter market that operates around the clock, except on weekends. So forex trading is basically all over the world. The banks, the Wall Street, everyone, this is what they are doing, trading stock, bonds, and so on like that. So this is something that every financial institution they are engaging with. They are all trading forex. So it is done only the times that banks are operating. Only the times that banks are operating globally. So except on weekends, we all know that banks don't work on weekends. So that is why we don't have anything on weekends. So only the time banks are operating globally. So it is the world's largest security market by nominal value, with trillions of dollars changing hands daily. So this is for you to know how large this forex market is. Remember I said something, every day by day, if you want change never to dollar, dollar to this, maybe through bureau the change or through one another, you've done forex. You've done forex. So for this forex trading, it is very important for you to know that we have some major um remember I said major. We have major. The reason for major is there are others on trading section, but these are the ones you need to focus on. Four major trading sections. We have the Sydney sections, we have the Tokyo section, we have the London section, and we have the New York section. Remember, we have four major trading sections. We have the Sydney section, we have the Tokyo section, we have the London section, and we have the New York section. So in this major trading section, you should know the timing that all of them they operate. And these are the timing here from 1500 to 2330, the Sydney section. From this 2330 all the way overlap to the London section. The London section start as early as as early as 7 to 6 a.m. Nigerian time. So overlaps all the way to the London section to the New York section. The New York section starts from 1 p.m. and also end by the time the bank is closing here in Nigeria, which is 5 p.m. So we are very, very lucky. Now, out of all these sections, which section should you pay attention more? Most people, if you are looking for more volumes, the big guys trading, you have to focus on the London section and the New York section, because that is where you have people moving money. People in the New York, in the London, they have so much money and they are moving it. Here in Nigeria, we are very lucky because those times in other countries, those New York and London section fall in between their day or their night or their midnight. But here in Nigeria, our own London section, let's say starting from your 6 a.m. 6 a.m. is early in the morning already. 6, 7, 8, and so on like that. While the New York section is starting from 1 p.m. to 5 p.m., which is a very good time for us to even work. So the Sydney and Tokyo section is our night, so you can even choose to leave those because the London and New York section is where you see the big guys trading in billions and thousands and millions and so on like that. Now we are going to move to another important part of this, which is the pips and pipettes. So a lot of us we would have seen maybe on our trading chart on our MT5, MT4, you will see something like 1.19. this and that for the value. You will see something of 1.13, but you don't know the meaning. We have what we call the pips. We have what we call the pipettes. We have the pips. We have the pipettes. So it is very important you understand what pips are and what is pipettes. Now, you see the fourth number after the decimal point of any currency pair is known as your pip. The fourth number after the decimal point is known as your pip. Market moves in pips. Market moves in pips. So please pay attention, and it's important for us to know this. The fourth number after the decimal point is known as your pips, while the last is known as your pipette. So this is just like minutes and seconds. So the pipette is the one that is going to read up to 9, and it's going to give you read up to 10 to make 1 pip. That is the pipette. The pipette is serving as the seconds here, while the pip is serving as your minutes. So if you see maybe in a trading signal group, you are hearing put your stop loss in 10 pips, put your stop loss in 20 pips. This is what they are telling you. This is what they are telling you. This is what they are telling you. So it is very simple. Now, how do you calculate pips? How do you calculate pips? It is very simple. Let's say you enter Euro USD at 1.03146 and you leave the market, maybe you close your profit at 1.03100. What you need to do is to remove your exit price from your entry price, saying this 1.03146 minus 1.03100 is going to give you this value. Now divide this value by 0.001 and you are going to get 4.6, which means the pips you earn in this trade is just 4.6. Now we move to spread. Let's go to spread. Now spread is the difference between your bid and your ask price. Your bid and your ask price, which represent the cost of the trade. So we have so many people, there are so many brokers, and we have people saying, oh, with this broker, how are they earning? How is Exness earning? How is equity earning? How is all of them earning? This is because they charge you with these pips, with this spread. Sorry, they charge you with this spread. So if you open your MT5, you will be seeing maybe one green line, one red line, or one blue line, one red line. The difference in between them is called the spread. That is why whenever you enter a trade, you see that once you click on buy or sell, you'll be in loss. And that is why all these brokers also have another thing they call the zero spread. So if you are not on a zero spread and you have this thing like that, you will see that you are in loss because of as you enter the market, due to have been quoting you some losses, because this is how they charge. That is their own spread. That blue and the red line, which is the buy and the ask price. I believe that is clear. So we are moving to the next screen right here, which I'm going to be explaining lots. We are going to explain lots, and yeah. So before we go on lots, let me give opportunity to the person that wants to join right now and admit the person. Okay, so all right, then let's go back. Now, what is a lot? A lot is a standardized unit of measurement used to trade currency in the forex market. Many of us would have seen where we have maybe something like 1 lot, 2 lot, 0.1 lot, 0.01 lot, and so on like that. This lot size is what we use to trade the forex market. So there are different lot size. We have the standard lot, we have the mini lot, we have the micro lot, we have the nano lot. So anytime you hear of the standard lot is 100,000 unit of the base currency. Mini lot is 10,000 unit of the base currency. Micro lot is 1,000 units of the base currency. Now, before we go to this, let's look at the example. We use Euro USD as an example, and remember we said something like standard lot is 100,000 unit of the base currency. Now, what is base currency based on our previous video? Euro is the base currency. So standard lot, what is standard lot? 1 is standard lot. If you look at this lot size table here, 1 standard lot, mini lot is 0.1, micro lot is 0.01, nano lot is 0.001. We can see it here. Now, I'm going to explain something later, but let's focus on this first. Now, for this lot example, 1 lot is equals to 100,000 units of the base currency. Meaning, and let's say for example that this is the current price of euro, which is 1.071141. That is the current price of euro. Now, to buy 1 lot, meaning for you to use 1 lot size to trade, you will need to have $107,000 in your balance. To buy a 0.1 lot, for you to trade with 0.1 lot size, you must have 10,714 in your balance. To buy a 0.01 lot, then you must have 1,071 in your balance. That means for you to open your trade and trade with this lot size, this is what you must have in your balance. This is what you must have in your balance. Now, let me explain how this lot size, how you earn in this lot size per pips. When you are trading with standard lot, for every pip movement, you are going to be getting $10. For example, remember we said pips is the fourth after the decimal place, which is, this is your pips. This 4 here we have here is called pip. This is your pip. So if you enter your price at this price here and you say you should buy, if this 4 should turn to 5, you have made $10. If this should turn to 6, you've made $20. If this should turn like that. So for every standard lot, you earn $10 per pip. For every mini lot size you enter, you earn $1 per pip. For every 0.01 is micro lot size you enter, you earn $0.1 per pip, and so on like that. Now remember I said something. If you do not have up to $107,000 in your balance, you cannot trade with 1 lot size. If you do not have 0.1 lot size in your balance, you cannot trade with 10,000 lot. You cannot trade with 0. If you do not have 10,000 in your balance, you can't trade with 0.1 lot. If you do not have 1,000 in your balance, you cannot trade with 0.01. Now, I know many of you will feel like, I've seen so many traders now trading with 1 lot, 2 lots with just $50 in their balance, $100 in their balance. Yes, it is possible. That is because everyone is using what we call leverage. We are all using what we call leverage. Now, what is leverage? Leverage is the techniques that allow investors to use a borrow money to control a larger amount of money than they would have in their own cash balance in the forex. In the forex trading, leverage is commonly used to profit from small price changes in currency pair. For example, if you have $100 in your balance and you are using a broker like Exness now and your leverage is 1:100, it's just like you saying 100 times 100, which is going to give us what? 10,000. Automatically, that your $100 balance has turned to $10,000 because your broker has given you a leverage of 100 to make your balance turn to 10,000. And that is how you will be able to enter any lot size. You'll be able to enter the lot size that is amount to this 10,000 and so on. So some people is using leverage of 1:200. 200 and you have $100 balance. That is, your money has turned to 20,000. If you use 500, so on, you use unlimited and so on. So these are the example of leverage. And we have equity in trading. Equity, we have the which is the referred to the value you hold on your forex account. So once we are doing using our MT5, I'm going to show us this equity, free margin, and margin call. Equity, free margin, and margin call. So now we are going straight to the chart. Okay guys, so now we are going to discuss about the technical part of trading. What we are going to be what we'll be discussing about first is our support and resistance. Support and resistance, which is very, very important tools in trading. So I will just walk you through this trading view. Let's just do this because we have, let me say, 7 minutes to do this so that we can. I want us to take two topics in this 15 minutes. So now this is um trend line. When you see trend line, these are your tools that you can use your trend line. You can click on it, you'll see other things here. On this bar here right now, you will see your fee retracement and so on like that. On here, you can see your pattern. Here, you can see your projection, forecast, and so on. Here, you will see your geometric shape. Here, you can see your text if you want to write a note and so on like that. We have that here. So on this here, this is our currency here right here. If you click on this, you are going to see something like this, which you can change to. You can click on it and change it to any one. If you want GBP, you can just cancel and type GBP USD, and it's going to give us the GBP USD. We click on it and so on like that. So now this is euro we are using. Let me just cancel this. And here we have our time. If you click on this, we are on 1 day. So this is everything, 15 minutes, 1 minute, and so on like that. So let me take us on this are minute. So let me take us on candlestick. Candlestick is the first thing we will discuss here. Then we move to our support and resistance. Now, okay, I have to do this. Now you can see here we have 1 day. 1 day. So this time has a lot to say with the candles you are seeing here. If this is 1 day, it means that each and every one of these candles you are seeing here, they represent 1 day. That is 24 hours. So you see this candle you are seeing here, each and every one of them, each and every one as they are timing this small one, everything. This represents what happened in the market for the whole entire day. Now, if I should change this day to 4 hours, if I change to 4 hours, now this means you can see that we have different chart pattern here in 4 hours. This means that each and every candle represents what happened in this market for the last 4 hours. For the last 4 hours, the market is tanking. For the last 4 hours, it's move up. For the last 4 hours, like the previous 4 hours, the previous 4 hours, just like that. For 4 hours, all these are 4 hours candle. That is why if you look at this, just check what I have below here. Friday 20 by 18:00. If you go to the second one, you will see 14:00. If you minus it 18 to 14, that is 4 hours. If you go to the third one, you will see 10. If you see 11, 12, 1, 2, you can see 2 is 14. If you minus 4 from 10, what are we going to get? 9, 8, 7, 6. So if you go to the next one, you will see 6. That is it. Every candle represents for 4 hours. Now, everything represents what is happening in every time frame. So if you put this on 15 minutes now, it shows that one candle represents just 15 minutes, 15 minutes, 15 minutes, 15 minutes, 15 minutes, like that. That's how it is, 15 minutes. So now, how do we work with this? How do we work with this? It's very simple. How do we work with this? So this is it. I want to explain what happened in this particular candle. So we have the green candle and we have the red candle. I'm going to take this candle as an example, which is we have what we call the entry. This particular point here, in this particular candle here, this is where the market this is okay. Let me take it's reverse. I take, what is it called? Let me a candle with red and green. Okay, yeah. Let's start with this particular candle here. So it is very important you also learn how to read candle. You learn how to read candle. So if you have something like this, sorry, if you have something like this, you have to know which one is the open price, which one is the closing price. So you have something like this again. Don't let me waste time. Okay, yeah. Look at this here right now. So we are looking at this green candle. we are looking at this green candle. So looking at this red candle, you can see the market push down from here. So from this red candle starting here, this is the opening price. Yeah, this is the opening price here. Let me map it out here. So this is the opening price of this particular candle here, and we are in 15 minutes. This is the opening price. So after the price opened, you see this small wick that is there. Buyers push it up to make this small wick here and see if it wants to go up. But because of this market wants to go down and we have a lot of people selling it, so those sellers are the one that push this price down all the way to here. They push the price down all the way to here. That is why we are seeing a wick here. So after pushing the price down, you see this red body candle. It was filled to this point initially. After they pull this price down, then the buyers also now push the price up. The buyers want to gain momentum back, so they try to push the price up, but they are unable to push the price up back. This is where they are able to push the back up price up to before the end of the 15 minutes. So after they push the price up here, then the 15-minute times elapsed and another candle opens. So this is the closing price. So this is a summary. Here is the opening price of this particular candle. Here is the maximum point at which the price reached, and here is the closing price. So as the price closes here, another candle will open at the same point at which this previous red candle closes. So this we have another opening price. Now, if they say what happened in this candle, because you have to know how to read the candle. What happened in this candle? What happened here? What actually happened here? What actually happened here was like the price moved the sellers after this price opened here. The sellers are the one that first push the price down up to this level. They push the price down to this level. So after putting the price down to this level, sellers feel like yes, they've gained the momentum. Then the buyer said no, which is the bull. No, we have to also do something. So the buyers now make sure they push the price back, getting to this entry point. Then after, you see, this candle was previously red coming down here. But when these buyers push the price up to this entry point, then the color will now change to green. Then the buyers now push the price up to this maximum point here. They push the price up to this maximum point here. Don't forget that here is the opening price. Here is the opening price. Here is the maximum bottom that the seller push the price to before the buyers now push it from this bottom up to this top here, which is the highest point. So after the buyers push it up to this point, the seller was like, are we sleeping? No, now these people are gaining momentum. Let us also do something. The sellers now push the price down back to this. They push the price down back to this place. So after the seller push the price down to this point here, then the whole 15 minutes has reached already. Then we have another candle that open here. I believe you understand this is very simple. So that is all on candlestick, on how to read candlestick. I have a full video on my what is it called? My YouTube about candlestick. I also have a video on my TikTok on candlesticks. If you need more detailed explanation on it, please check my YouTube or check my TikTok. So yeah, let's go now to support and resistance. I think I might have to log in if you are getting this. So support and resistance is very simple. For us to use our support and resistance, we need the tools. So we need the tools. So what are the tools we are going to use? This is it here. We come here, we come here, we select what we call horizontal line. So we'll click on this horizontal line. To do is we want to map out the point at which whenever market reaches that point, the market there will be a reaction. So we are looking for an order block, a point at which anytime market reaches that point, there will surely be and reaction. There will be a reaction at that point. So now, whenever we see those points, just mark it out. So this is a point here. You see, I will just mark this one out. I've marked this out. Let's go back in time. I want us to go back in time. This is another point here. I want to mark it out. So I'm just going to be citing 2 examples for this so that we can move to the next one. Yeah. I also run a mentorship class. If you need more after today, you can also join. So yeah, I've mapped like 2 points. So what I did was I basically map out a region where that whenever prices touches those regions, there's always a reaction. And if you look at this first line, if you notice, we drew this first line from here. But I can tell you something. If you look back in time, you see that this line we put here also serve as a support and resistance for other candles. Look at what is happening here. But don't let us go back. So we can digest this. So look at what happened. Let me explain this for you. See, this is a support line. Remember I said just map out, go to your chart. If you are with your laptop, go to your chart, map out a region where price touches constantly. Now, this is how it is here. How do you trade with support and resistance? Look at this. Whenever you see price going, look at price touch this region, retrace back down, come back again, touch this region, retrace back down, and after that it broke out of the region, the point whereby price is making a reaction. So whenever price touches it, you wait, and whenever price move back again to touch that point, then you know that since price touch this reverse back down, then whenever it's touching it next, it will definitely reverse back down. So from here, you go for your sell, you sell it. You target your nearest support. Look at here, there is a support angle. Price touches, come back here, then go back up. So if you are selling here, you should know that here will be your target to take out your money. It's very simple. Now, whenever price broke through the support line, now this support line will automatically turn a resistant line. Support line is also a resistant line, meaning if price is going like this, like it's touching this line is serving as a resistance for this price. Yes, please take note. Particular line is serving as a resistance because it's coming back down. Going back up, resistance is pushing it. It's like something that wants to run through a wall, and the wall is pushing it back, pushing it back. Now, whenever now this thing, the price now have to use long green candle with forces to break through resistance. And after breaking through this resistance, anytime price come back to this line, from here to this line is now no longer a resistance, to now turn a support, because it will be what that will be pushing this thing up. Now, resistance breaking through here, you will see a lot of sellers putting on buy. They will buy it and tie the nearest one. Now, look at this. Look at what happened here. We also have a line here. Coming back here, touching here again. Look at it. Another resistance. It come back down here. It came back down here. Do this, and do that. Now, let's go. Coming, you can see this line is now serving as a support. Instead of this to fall down to this region, because of this line is finding a support there. And at this support region, you will see many traders going for long. They will buy at this region. You can see buy at this region. On getting to this region, they will sell. They've taken their profits. They will go again out. You see, this is breakout. After this breakout, many traders will go for short. After this breakout, you see, oh, it has broken the support line. Let's go for short. This is another strategy. So in trading, you have to have a strategy. We have some traders, this is the only strategy they trade. They'll wait for a support, bounce, they'll wait for a support to trade on every support and resistance, and some also wait for a breakout and trade on it. Look at the breakout here. You can trade after this price broken through this support and resistance line. On going back up, this thing turned to a resistance. It turns to a resistance on going back up. It turns to a resistance on going back. So yeah, we are going to save this, and I'm going to log in. By the time we'll be doing the next, which is the we go with the trend line. So I think with that we can have the last memory of what we've done, and I will be able to this what is appearing on the screen won't be appearing anymore. So I'll just register a new account on TradingView, and we'll use that for the next explanation. Yeah, because like this I think we've lost what we've done on the line on the screen. So yeah, and this is 15 minutes already. It's 15. We are discussing on trend line, bit of support, then we go on trend line and chart pattern. We'll go on trend line and we explain more on chart pattern. So yeah, okay. All right. So guys, for trend line is still the same thing. We are going to go to the higher time frame. It's very important. You can also draw your trend from the lower time frame, but I like drawing my analysis from the higher time frame, because in that way I'll be able to see far. We have two what is it called, two ways you can trade trend line. One is the trend line break, and the other one is the trend line bounce. So I'm going to be taking you this. So to draw your trend line is very simple. You see, the same place you are able to pick your what is it called, your horizontal line that we use for the support and resistance. That is the same place you are going to pick your. So you come here, you click on this place where we selected our horizontal line. You can see what we have here. It is called a trend line. It is called a trend line. So on this trend line, I'm going to click on this trend line, and we switch this to trend line. So what you want to look out for in a trend line is we want to draw a trend, a line that we allow us to know the trend of the market. Now, this is what we want to do. Pay attention to the point at which I'm drawing this from. You can see the point I'm drawing this from. So if you are drawing your trend line, you want to ensure that two or more candles are touching this line. And I'm not talking about, it can be the body, it can. So if the candle is having a wick, it has to be at least the wicks are touching the line. At least two should be touching the line. That is what is going to make it a valid trend line. Without this thing touching there, it is invalid. So after doing it, you can still zoom in to adjust it. So yeah, you can zoom in to adjust it. So let me just, so this is, look at what I'm doing. Look at what I'm doing. So you can zoom in to adjust the switching and like that. So since I have two touching, that has already made this my trend line a valid trend line. So I can draw a trend line to the upper side too. You come here, you pick on your trend line. You pick on your trend line, you pick a point. So I'm picking this point here. So I ensure that at least two is touching. I want to ensure at least I have two of this line touching. At least two should be touching. At least two. So if I have it here, I can also have my trend line with this. So this is a chart pattern that, so I do, this is a chart pattern which many people might be familiar with, but let me just go with the simple trend line that we have here. So we can also have our trend line like this, being drawn like this. Let me just make it from here to here. We should have a better trend line coming from this guy here. Let's use this guy here, and should should be should be here. We need to use the wicks and ensure that they are touching to be sure that these guys are touching. So you can zoom in, and be sure. So yeah, let me explain how you trade trend line. So you know, upon, like, just like I was explaining the support and resistance, once you have a trend and you have your trend like this being drawn up and down, then you can now identify your trend. There is one thing we call trend line break, and there is what we call trend line bounce. So you see, trend line break bounce is when we have something like this. The markets keep on going, the candles will go from the the candles will move from this region here. It will touch this upper trend, come back down. Sorry, I have to, let me exit this. Let me use this part. Yeah, part will do the work better. So the candle will come from this region here. We touch here, come back here, go back up, touch here, go back up, and so on like that. That is trend line bounce, like bouncing between the trend lines. So how do you trade trend line bounce as a trader? As a trader, if you want to trade trend line bounce, you just basically enter at the points here. Let's say you've identified your trend line. Upon it, one and two, you've used this one and two. One, two, you remember I said must touch one, two. You've used this one, two to identify the first one. You've used this one to identify the second one. So upon it going back up from here you buy to here, from here you sell to here, from here you buy to here, from here you sell to here. That is how you trade trend line bounce. Now what I'm teaching you now is how you have your entry. Now let's talk about, I'm going to draw another trend line. I'm going to draw another trend line, and I'm going to show you how you trade your, let's go to 15 minutes. Yeah, trying to cover many of these things today. We have just, you can see that this trend line, this one we have here is very, very big and long. I'm trying to cover a lot today. Let me just do this like this. Let's remove this. So let's look for a clear trend line break. This is also the same thing. Your trend line can be facing down or can be facing up. So it's also the same thing. So let's look at, yes, I'm seeing a break here, but let's for example. I have to zoom. So this trend line is another good analysis which you can use to identify your trade. It's very good analysis to identify your trade. So um let's talk about how to know the trend of the market. Let's identify the trend line. The trend line, what is it called? Wait, yeah, let's identify the trend line first. So after identifying the trend, goes on how do we trade, how do we trade the how do we identify the trend of the market? How do you know? So now this is a trend line. You can see what happened here. Upon touching here, touching here, touching here, touching here. So you can either trade the bounce, which is trading inside the trend line, or a break. And this is a break here. After we have a break here, there's one thing we call break and retest. So after we have a breakout here, you can see the market have to retest by touching this our trend line back, and after that, look at what happened. It has been tanking ever since then. So it is very, very powerful. So we have some traders that what they trade only is breakout. Trend the candles to break out. Once they have their breakout on the trend line, they'll wait for the retest. And after they have the retest on that trend line, they'll buy shorts. And that is how they bag big profit. So these are the ways you can trade your trend line, a trend line break or trend line bounce. Now let's talk on how to identify the trend. How do you identify the trend? So to identify the trend, to know which trend we are currently on, maybe we are in the uptrend or downtrend, you can identify the trend using two ways. The first is by using the moving average. You come here on this indicator, then you type moving average. That is moving average exponential. Moving average exponential. So once you have the indicator, you are going to on the indicator, and on your chart, you should be seeing indicator. This is it here. So you will now click on this moving average exponential. You come here, you click on settings. You are going to change the length of this from 9, you change it to 200. So where is my button? Where's my button? From here, you change to 200. So you change to 200. That. So after changing to 200, this is now this moving average is very powerful. Yeah, it's part of what we are. It's very powerful, and this is how the moving average also serves as a support and resistance. So on this moving average, anytime you see price trading below this line, then it indicates we are moving in a downtrend, and whenever your price is trading above this moving average, then we are in an uptrend. You can see what is happening here. We are in an uptrend, so you can use that one to know the type of trend we have. You can see above means the price is about to tank. I mean, below means the price is tanking down, while above means the price is going up. So you can use moving average to determine your trend. The other thing you can use to determine your trend is to use your higher highs and higher lows. So you would have seen so many traders saying higher highs and higher lows, something like this. Now let's discuss about psychology in trading. You see, trading psychology is one of the important aspects in trading, and not many traders do use it. I also have a full video talking about trading psychology. Okay, so I'm going to make this part to be very, very short so that we can also try to look into chart pattern. I'm just saying that we have so many to cover, but yeah, we can do it. So trading psychology is very simple. Uh, it is you paying attention to the market psychologically. Like, remember, let's remember the what exactly Forex is all about. Is about we buying low and selling high. That is the most important thing about Forex, because we want to make profits. We want to make profits. So now, looking at the psychology part in trading is looking at the rounded figure. Let's say, for example, look at this point here, 1.1.15500. Now, on this point here, you can come here, on this point here, take your horizontal line, then mark this point out here. We can edit it. So let's edit it and put um let's edit it and put 1.4500 here. I mean 1.5500. Okay, so I'm waiting for 1.5500. Now I'm going to explain this for us to know why exactly I have this point here. Now let's take, for example, you want to buy a gadget, let's say an iPhone now. Or let me use something. Let's say you want to buy a clothes. You want to buy clothes, and getting to the market, they said, oh, the price of this clothes is 10,700. For example, the price of this clothes is going for 10,700. Now, you as somebody, if you want to price this clothes, it is not a fixed price, you understand? But they said it is going for 10,700, and you want to price the clothes. What will be the amount that you are going to price that clothes for? You will feel like, no, now why 700 naira? Why don't I pay? Let's say you are even that rich man boy now, you have money, you want to do like a big boy, you say, 10,700, why? Let me just pay 10,500, because psychologically you feel like, what is the 200 naira doing here? The nearest price you are going to price it will be 10,500. And after that, let's say like someone like maybe someone like us now, us like understand, they will say 10,700. No, we are paying 10,000 naira. We will try to cut away that small number that is on top of it. And that is psychology. Why are we cutting away that? Because we want to buy it at that particular lower price, at that particular lower value. That is why we are cutting away those 700 naira and so on that is there. So that is trading psychology. That is trading psychology. You want to ensure that you think at, okay, what is the price that many people will want to buy these things? So this is Forex. Remember I said Forex is about you trading currencies and with the aim of making profit from it. And to make profit, we want to buy those currency at a lower price and we want to sell it whenever the price is higher value. So now I've picked this point as our first psychological point, which is 1.15500. And now we are looking at, this is a psychological point. So to do psychological points, you are going to do 50 pips up, 50 pips down. 50 pips up, 50 pips down. So this is what we are going to do. Remember what I call your pips. Remember your pips, remember your pips. So now 50 pips up, 50 pips down. You can take your measurement to measure it, but I don't need to do that because we have just less than 20 minutes to conclude this. So I'll just be fast with it. So our next psychological point here is going to be 1.500. So just put it here, then I'm going to just put, I'll use, let me just change this 5000, and that is done. So after this psychological point, the next one will be, just pick your line. The next one will be 1 point what? 45. Yeah, 45. So 1.45. So let's just do this to be fast. 1.1450. So yeah, this is 50 pips of 50 pips. Now, this psychology region I'm telling you of magic. If you do not even know anything about the support and resistance I've said, you don't know how to pick your support points, you don't know how to pick your resistance points. Believe me, this psychology works for you. Just put it. It is very simple. Now look at what happened. How do you trade with this? See, this psychological point is, you are trading. You as a trader, you are a unit trader, but we have the whales, the big boys, the Wall Street guys, brokers, people putting billions, millions of USD in this market. But now you are able to think as them. You see, those people too, it is not like they are rich, they don't know how to think. Because these people also, what they usually do is they want to buy this particular coin at a point they know that it is the best price. Everyone is looking at the best price. We are resellers here, we are traders here. The same way you are buying your clothes, the same way you are buying your shoes, the same way you are buying your commodity, you want to buy this also and you want to sell it at a higher price. Now you've used your psychological point to pinpoint 50 pieces up, 50 pieces down, that okay, people always like to buy something at a rounded figure, and that is a mentality, it is a psychology for me, you, and everybody out there. So psychology in trading, this allow you to trade just like the way you know that every other person is going to reason, just like the way you know every other person is going to think. This is what you are also doing. You are thinking, you are reasoning just like people. Now, you putting at 1.14500, it is because we have this price doing all these things here, doing all these things here. But you see this at 1.14500, there are members that will be waiting for price to come to this point they should buy, because this is a psychological point. Now, what sense does it make if I'm buying this thing at 1.14812? 1.14812. You just like the same example I made to you, that okay, if you walk into a store, you want to buy a clothes, they say this clothes is 1,700 or 1,720 or 1,000. You feel like, why should I buy it at 1,700? Will you sell it 1,500, or will you sell it, 10,500, or will you sell it 10,000 naira for me? That is the psychology. You want to price it down. So the same way all these traders, the whales, they are also waiting for a point. They know that this point is a very good point for them to go in. They know, oh, this is a good point, I want to go in at this point here. So what they will do is they will wait for the price to come down to 1.14500. Remember that we put this line here just psychological points. We don't even know whatever is happening here. But look at what happened. Price got in here. We have so many people willing to buy. They bought it up. They pushed the price up, and within that moment, some people started taking their profits because there is a resistance region here. After taking their profit, the price reached this region. Now, this region has become interesting, and you can see they bought it also, push it up, and you can see price never broke beyond this region. It kept on moving up, moving up, moving on. It keeps on moving up, keeping on moving up, and that is it. And look at it here. After psychology point region, which is 1.1500, going back up here, we have 1.15307. People will feel like, no, I can't buy at this price. I have to wait. Yes, I might miss the 1.14500, but yes, let it at least come to 1.1500, then I'll buy. Coming back, a lot of people buying. So this is psychology in trading. Very, very simple. Now let's go to the next one, which is the chart pattern. Let's go talk about the chart pattern. This chart pattern, we have what we call we have the M pattern, which is like this, also known as the double top. We have the W pattern, known as the double bottom. We have the W pattern known as the, sorry. So we have the W pattern. Let me just change this. Sorry, part. We have the W pattern, the double bottom. We have what we call the head and shoulder pattern, often like this. So I'm just going to talk about these two patterns, let's say in maybe 2 minutes or so, in 5 minutes. Yeah, let's use 5 minutes. So we have the head and shoulder pattern. They have the head and shoulder pattern just like this. So there's always a shoulder here. There's always a shoulder here. So all stand in M pattern in a downtrend, then you should know that the market is going down. Whenever you see this W pattern, you should know the market is going. So how do you trade it? So the M pattern, we trade the M pattern by waiting for the market to break these points here. Let me remove this. Okay. Remove. So you do, let me remove all this so that we can have a clean shot. Yeah. You wait for the market to, let's use this line here. You can either take your entry horizontally. You can either take your entry upon the point here, or you enter from this below here. Once you see it from the W, you enter. So I do enter my own trade. Once I can see it coming back here, I know that this is a W and it's at the support level. I go on my buy. So I get a lot of pips going back up. Even from year to year, I've made some profit already, talking of breaking it up. And some traders do wait for this breakout to get their confirmation, and after the breakout they wait for a bit of a test and they buy. Some traders upon the breakouts they buy up like that. Same thing with the W pattern, the same way you trade at this double bottom. Now let's identify M and W pattern on the chart here. Let's identify the M and W pattern on this chart here. So without even going more far, we can see 1 year. We can see 1 year. This is 1 year. Look at this. Look at this W pattern. Just look at this. You can see what I'm saying. See, you can see what happened. This is W pattern. So as simple as that. So if you look at the chart also, we will see more W pattern. Now let's look for this guy, this head and let's look for this head and shoulder pattern. Yes, I can see 1 year. 1 year. This is, you can see, look at the drawing. Look at the drawing. I used to say, you learn, you earn. This is purely experience. It's not like this. You look, you wait until you see the pattern and you trade. This is how some traders trade. You don't just jump into the market. You wait. Look at its head and shoulder pattern. It is head pattern. Then master is it. That is head and shoulder pattern. So guys, that is that on chart pattern. We have other chart patterns on my group, and yeah, we'll still have some, maybe make more video on that. Like I said, we do run monthly mentorship also. If you are interested, you can join to know more about all these things. So now let's talk about risk management. Let's talk about risk management. So there is a site where we call baby pips, where you can calculate your pips, how you take your risk. So you can either trade in a risky manner and you can also trade in a conservative way. I know many of you have seen some of my posts where I will say I'm flipping accounts. Believe me, even with flipping accounts, there is always a risk management. I can't flip an account with a balance that I know that I'm not willing to lose. So for every traders that do flip account, this is how everyone do it. We always ensure that, you see, instead of having that $1,000, $500 in your account, and you enter a trade, you put a stop loss of $50. That means you want to risk 10% of your $500, and you are aiming high. Now for flipping, you see, that money you want to risk is the only money you are going to deposit in your account. So do not make this mistake of you want to flip, then you have $500 and you want to flip. You will lose your money. You will lose, because any small drawdown like this, bam, your whole $500 is gone. But for those flipping, for traders that are flipping, we have this $50, $100 that we want to flip, and that is what we'll put there. $50, $100, we put it there, and we'll be aiming to flip it up. We'll flip it up. That is how it is. So if you know that it is flipping you want to do, just put the money you want to risk. Your $50, your $100. If it is out, you trade gold. If it is GBP, you trade it. Just the money you want to risk. That is how we control the risk in flipping. So you will see every traders. You have different wallet, and you have your what is it called? Your trading accounts. You have, I mean, your conservative wallet trading account, your flipping account, so that you can keep on funding. Where you have your $1,000, you cannot flip with $1,000, because any small mistake you might lose your money. And that is why you see so many people out there, they want to flip $1,000 to $10,000. They will now go on social media and be saying trading is scam. So all these things are very important for everyone to learn. So we've come to the end of today's tutorial, and I believe every one of us have gained one or two things. It is a very long 3 hours class. Wow. So thank you, and I will thank myself too. I don't try. So I'm going to compile everything, post on YouTube also for those that are not here, and those that joined us earlier that couldn't wait till the end of the class, so that they can also get to look at it. And yeah, even posting it will be worth 3 hours. Wow. So um like I said, I have the trading group, which we drop trade signals and more educative video. And also on my YouTube channel, you can stay tuned. I will still make more videos on chart pattern, make more videos on different things. And you can also come subscribe for mentorship, 1 month mentorship, and so on. For now, we are taking online, and very soon we are going to start our physical class. So that is all for now. So yeah, I'm going to stop recording. Yeah.